different. Well, the Dow is on its track for its worst day since 2008, and there's a lot of turmoil that we're talking about throughout the programme. And the comparison that we're saying between the financial crisis now and 2008, well, the stock market shocks may seem similar, but there are some complete differences. Remember, we've constantly talked about the economic house. The IMF always wants us to fix the roof. Well, in 2008, as the subprime mortgage crisis got hold, the economies appeared to be on strong surfaces. We had the crash of the Lehman Brothers, which had a market panic. But what we discovered, banks worldwide, from global banks like Chase and Bank of America, Wells Fargo, through to Landesbanks in Germany, we found out that the subprime mortgages and the defaults had infiltrated the balance sheets and the foundations of the bank. They were loaded up with bad debt. They had high-risk loans. And as a result, the foundations were risky. 101.3 trillion in outstanding loans, high debt, high risks. The US economy was unable to withstand this pressure. That was 2008. Now, 2020, and the picture's very different. Of course, in 2020, the market is still rattled by oil price wars, coronavirus. But look at the foundations of our house. You'll see it's totally different. The post-crisis regulation has reigned in lending. There's much higher capital ratios, Tier 1 capital. There are far few subprime loans, and the banks have been stress-tested again and again and again. This is not 2008 all over again. Gita Gopinath is the chief economist at the International Monetary Fund. She joins me now. Good to see you, Gita, as always. We'll draw comparisons with 2008 in just a moment. First, though, right at the top, what's the IMF now expecting? Are you looking for either a recession in the US or a global recession?
I mean, Richard, I can tell you what we know now, which is that our estimate for growth for 2020 is going to be below what it was for 2019, which, if you remember, was 2.9%. And also, if you recall, that was the lowest since the global financial crisis. So we are going to go below that this year. And the question is, where do we end? Now, that's going to depend upon how the next several days unravel. And there is tremendous uncertainty there. But there is no doubt that this is a big hit to the economies. You know, it started out with China, first quarter being particularly weak. But as the health crisis is rolling over many other countries, we can see other countries getting hit severely for 1 or 2 quarters going forward. Now, how all of this ends is something we still have to figure out.
Right, so we can, I mean, we can put the economic forecasting in the sense, I imagine it's extremely murky with so many different undercurrents at the moment. But if we do look at what's concerning, the last thing, please, the last thing we needed was an oil price war between Russia and Saudi Arabia. Would you agree?
I mean, it is the events that we saw today clearly raise the level of concern significantly. I mean, a big collapse in commodity prices. We saw a big one that happened in 2014, and now some might argue, well, that's good for countries that import, it's greater purchasing power. But on net, we know that for the global economy as a whole, the big negative hit on commodity exporters kind of outweighs the positive hit on importers, and so it tends to be a net negative for global growth. So this certainly adds a whole lot more to the turbulence and the uncertainty and the costs for the world economy.
We can. Your boss was telling us that the other day, Kristalina, the managing director, she was saying that you were looking for countries to spend more on to strengthen up the healthcare systems, to spend more in those sort of areas. That's fair enough. But would you also like to see macroeconomic fiscal stimulus across the board?
I think we're calling for what we call as large targeted stimulus. So this has to be substantial, but it has to be targeted, because this crisis is like no other. There are shocks to demand, there are shocks to supply, and some sectors are much bigger hit than others. If you look at airlines and tourism and entertainment, the effects there are just much more substantial. I think what we have to keep in mind is that inherently, the nature of the shock is transitory. It's temporary. We just have to make sure that policies respond fast enough so that people keep their jobs, businesses don't go bankrupt. So when things improve, then there is a faster recovery.
You make a very valid point and good point, ma'am, if you may say, the idea that it's transitory. Coronavirus will in some shape or form subside, assuming the right policies, healthcare policies. So that begs the question, which again, you may not have the information yet, but give me your thinking, please. Is it V? Is it U? Is it, I mean, what will the next 6 to 9 months look like in terms of a recovery?
I mean, Richard, I think we have to stop talking about the alphabet soup here. What is clear is that as the health crisis is rolling over other parts of the world, each country is going to have a quarter or two where they're going to get hit quite hard. Now, that, of course, has global implications if you're a large economy. On top of that, you add a commodity price collapse. And there are countries with high levels of external debt. There are major commodity exporters who are also exposed to this. And you have a financial crisis, a big strain in financial markets on top of that. So the question is, how do we get out of all of this? If cool heads can prevail and policies, targeted policies, can be put in place soon enough, and at the IMF, of course, we have the resources to help many of our our member countries, both financially and technically. If all hands can be on deck, if there can be a collaborative response to this particular crisis, then we can see ourselves getting out of this in a few quarters. But in the absence of that, I mean, this could last longer.
Good to see. There's a lot of ifs, and rightly so, but there's a lot of warnings and sensible advice. So thank you so much. I know.